Hello and welcome. Today we are digging into the story of a brand that I bet you have in your kitchen right now, MTR. We're going to go from its origins as a legendary tiffin room all the way to its parent company, Orkla India, getting ready for a huge IPO. Yeah, MTR. You know the name, right? For so many of us, that's the go-to for sambar powder, for those instant mixes when you need a quick breakfast. It's a staple. It's always there on the kitchen shelf. But here's the thing. Behind that familiar red and white packaging is an absolutely wild story. A uniquely Indian story of how a national crisis actually forced a beloved restaurant to completely reinvent itself, and in doing so, created the kitchen giant we know today. All right, so let's get right into it. The whole story kicks off back in the 1970s when a government law came out of nowhere and completely changed the game for one of Bengaluru's most iconic eateries. So check this out. MTR, the restaurant, it had been a legend since 1924. Then, boom, 1975 happens. The emergency is declared and the government puts these strict price caps on food. Now, if your entire reputation is built on quality, on using the best ingredients, well, that's a disaster. You just can't make your amazing food that cheap. So they had to temporarily shut the restaurant down. But here's the brilliant move. To stay in business, they started packaging and selling their secret spice powders. And, just like that, the MTR Foods business was born, purely out of necessity. So that's how it all got started. A crisis created a company. But how did it grow from that to the powerhouse it is today? Well, that's where the parent company, Orkla, comes in. They made a massive bet on two huge trends that are completely changing the Indian kitchen. First up, spices. You know, traditionally, you'd go to the local market and buy your spices loose. That is changing, and it's changing fast. Just look at these numbers. The packaged spice market is already massive, and it's projected to nearly double in just 5 years. We're talking about a huge shift towards branded, reliable quality. Okay, but here's where it gets even more interesting. It's the trend within the trend. It's not just about buying packaged turmeric anymore. It's about blended masalas, the sambar powders, the pav bhaji masalas. That market is also set to double. And why? It's simple, convenience and consistency. It takes all the guesswork out of getting that perfect taste every time. And that leads us straight to Orkla's second huge bet: convenience is king. I mean, think about it. More of us are living in cities, incomes are rising, life is getting busier, more women are in the workforce. What's the one thing nobody has enough of? Time. And that is exactly why the ready-to-eat and frozen food markets are just taking off, growing at a blistering 12 to 18% a year. So, this is a huge market, right? So how does Orkla compete? Well, instead of trying to be everything to everyone, they did something incredibly smart. They built an impenetrable fortress in their home turf of South India. This chart gives you a really clear snapshot of the business. Spices are the foundation, absolutely, making up 2/3 of their revenue. But you've got to keep your eye on that convenience food slice. It might be smaller now, but that is poised to be the engine of their future growth. And this slide right here, this is their secret sauce. This is what makes them so good. They understand that India isn't one market, it's 100 different markets. Take sambar. Sambar in Karnataka is not the same as sambar in Kerala, or the spicier kind you'll find in Andhra. Orkla doesn't just know this, they make different products for each state. This deep cultural understanding, that's their competitive advantage. It's their moat. And it turns out that hyper-local focus actually travels really well. A full 20%, that's 1 in every 5 rupees they earn, comes from exports. They're tapping into the global Indian diaspora, people who crave those authentic regional taste of home. In fact, their Eastern brand has been India's most exported spice brand for 24 years straight. That's amazing. Okay, let's talk money. Because as Orkla gets ready for its IPO, the financial story is, well, it's a classic investor's dilemma. You've got a rock-solid, profitable company on one side and some really serious questions about growth on the other. So first, the good news. This is a crazy profitable business. Just look at these numbers. The gross margins on their blended spices can be as high as 45 to 60%. For a consumer goods company, those are just phenomenal numbers. So here's the split personality right here. On one hand, the strengths are huge, fantastic margins, practically zero debt, and it's a cash-generating machine. But, on the other hand, the big questions. Revenue growth has totally stalled. The value of their spice revenue is actually falling, and their factories are barely being used. It's a real paradox. And this is the number that really makes you stop and think. In a market that we just said is booming, their revenue grew by a tiny 1.6% last year. In fact, the value of their spice sales actually went down. For an investor who's looking for growth, that is a major red flag.
And this might be even more worrying. Their factories are running at less than half their capacity, about 46%. And that raises a really tough question. Did they build all this capacity for a huge wave of demand that just never showed up?
Which brings us to the final critical billion rupee question for anyone looking at this company, especially as it gets ready to go public. What does the future actually hold? Let's be very clear about something. Orkla's greatest strength isn't something you can easily measure on a spreadsheet. It's this. It's their deep, almost encyclopedic knowledge of regional tastes. That's an intangible asset, and it's allowed them to build a powerful business that is very, very difficult for anyone else to replicate. And here is one final, crucial detail about this IPO. It's a pure offer for sale. Now, what that means is that none of the money from investors is going back into the company to build new factories or expand. Instead, that money goes directly to the existing owners who are selling off some of their shares.
And so, that's where we end up. We have a company that absolutely dominates its home turf, but it isn't raising money to expand. So the question is, where does that next wave of growth come from? For any potential investor, that is the billion rupee question.